Here is the hard truth about real estate investing. Most people don't buy their first investment property. Most people hold back. Why? Because they think they don't have enough money. But what if I told you that money is actually not a barrier? In this video, I am going to show you 6 proven money strategies that will help you turn your dream of owning an investment property into a reality. In fact, I've used a combination of these strategies to build my own portfolio. And in the next few minutes, I am going to break this down for you so you can do exactly the same. The first money strategy is a home equity line of credit. That is a HELOC. What is a HELOC? A HELOC is a flexible credit facility that allows you to tap into the equity of your home and to use the money as you need it. Let's look at an example. Let's say that you have a primary residence that is worth $700,000. And let's say that you currently have a first mortgage on this property with a lender, and that first mortgage is at $500,000. Here in Canada, you can access equity up to 80% of the value of a property. So if we run the math, take 80% multiplied by the value of $700,000 and subtract the first mortgage of $500,000, that leaves us with $60,000. That is the amount of money that you can pull from this property under a HELOC. And the beauty about a home equity line of credit is that on the day of closing, when you set it up, you are not getting this money in cash. So you're not paying principal and interest payment on this money. It's not sitting in a bank account for you where you're actually paying principal and interest. Instead, imagine it like a credit card. You basically have a card that has a limit of $60,000, and you can use this money in whatever capacity you want. You can use $5,000, you can use $1, you can use $10,000, or you can use the entire $60,000 if you want to. And you only pay interest on this money as you use it. So if you use, let's say, $20,000 out of this line of credit, and let's say the interest rate on this line of credit is 5%, okay? Then every month you are paying about $83 on this $20,000 that you've used. You pay as you go. Now, there are some disadvantages of using a secured line of credit, and let me tell you what they are. Because this is a interest rate that changes, it's actually like a variable rate mortgage. If the interest rates go up, then your payment for whatever amount of money you've used would also go up. So you have to make sure that if you're going to use this money to buy a rental property, that you have done 2 things. One, you've accounted for the payment of the money you've used in your calculation, in your cash flow calculation for the investment property that you're buying. And then 2, you've also stress tested the numbers, meaning if you're getting this today at an interest rate of 5%, I want you to stress test the numbers at a higher interest rate at 7%. What happens if the rate goes up to 7%? You want to make sure that you can afford it, and you want to make sure that the property cash flow will also cover for it. I love secured line of credits because they give me flexibility. You don't cost anything per month, and you can use some or all of it. There is a product on the street called Readvanceable line of credit. And the benefit of that program is that it's dynamic. You've got exactly the same line of credit that we talked about, but what tends to happen with an advanceable HELOC or an advanceable line of credit is as you make payments on this mortgage every month, okay, the limit on this line of credit increases. So let's say the payment on this $500,000 mortgage is $2,000 a month, all right? What happens is if half of this payment is going towards the mortgage principal pay down, and that's $1,000, then this line of credit limit would increase by $1,000. So fast forward 12 months, if you've paid, let's say, $24,000 of mortgage payments on your mortgage, and half of that is going towards paying down the principal on that mortgage, then that line of credit limit would increase by $12,000. And you don't need to requalify to actually tap into that increase, but every financial institution has its own rules on how you can access this money. If you're wondering who offers a HELOC these days in Canada, well, they're offered by the big 6 banks. Some credit unions offer them as well, and advanceable lines are also offered by the big 6 banks as well as some credit unions. So that is actually my most favorite funding strategy as a source of money for a first investment property.